Hello again, everyone. This is Sheila Vertino, and I'm your host for today. The Solution Series programs that we're going to participate in next are a free member benefit for NAIOP members. And they're like mini webinars. They run less than 30 minutes. The goal each time is to provide you with some quick tips, insights, positive strategies, tactics, things that will help you succeed in today's admittedly difficult business environment. As always, we encourage you to help us drive the content. What kinds of things would you like to hear about in future Solution Series programs? Specifically today, we're going to be dealing with retail issues regarding big boxes. Are there other retail issues that you'd like us to explore? And do you know anybody who might be a good speaker? You can email that to either to me or to Sandy Hudson, or you can basically just fill it in on the survey form that you'll get at the end of the presentation. And thanks in advance for helping us with that. I'd also like to thank our sponsor, and that's the Harvard Business School Real Estate Executive Education Programs. These programs are designed to help seasoned and emerging leaders protect their assets and manage complex projects. They also help participants navigate global markets and capitalize on new opportunities. For more information about these excellent programs, please visit exed.hbs.edu. And now we'll go to the second slide. As I mentioned before, some topics require more in-depth discussion than we can cover in a short Solution Series time frame. And so for that, we put them together in a webinar format. It's 90 minutes, and it has full interactivity. You can ask questions back and forth to the presenters. As you see on the screen, our next full webinar takes place on Thursday, September 30th. During this webinar, a panel of experts will discuss appropriate definitions of sustainability and explore the differences among LEED certification and achieving standards set under the Green Globes and Energy Star programs. They will also review the responsibilities imposed on project participants to meet stated goals in various types of commercial real estate development documents. The cost of this full webinar is $65 for NAIOP members and $95 for non-members. And to register, as you see on the screen, just go to naiop.org/webinars. And now let's get on with our Solution Series program. With us today is Garrick Brown, and Garrick's Vice President of Research for Colliers. Since 2009, Garrick's been responsible for tracking national retail trends. He is the editor of Colliers International's National Retail Reports, as well as the editor of Colliers' weekly retail newswire publication, which, trust me, sends you everything you could possibly want to know about the retail world. Who's doing what is in that publication. Before joining the Sacramento office of Colliers in 2002, Garrick worked as Director of Research for Colliers, Turley, Martin, Tucker in Indianapolis. He has also served as a commercial real estate appraiser with Cushman & Wakefield. I want to welcome you, Garrick, and thanks for being with us today. We're really eager to hear what you have to say about the big box dilemma.
Well, good morning, and thanks everyone for joining us. Yes, I'm here to speak about big box retail. I think certainly it's no surprise that commercial real estate's faced some very unique challenges over the last few years. And certainly the retail world has been no exception. Big box retail in particular has faced a number of big challenges that I'm going to discuss today. And there's also some opportunities that have come up because of this. There's actually some good news that I do have to share, despite at the front end I'm going to be talking about some statistics that are rather gloomy. Now I'm with Colliers International, and we track shopping center vacancy. We track it in 44 top U.S. markets. Just since 2007 alone, we've seen vacancy skyrocket throughout the United States. Just shopping centers alone, we've been looking at almost a full 5 percentage point increase. But you know, if you throw in freestanding retail, pretty much most of the markets we track have seen retail vacancy nearly double in the last 3 years. And that's been pretty much across the board, even some of our strongest markets. If you look at what's been driving that vacancy, big box has been at the forefront of it. In essence, according to CoStar, if you look at their current statistics, we're talking about just under 900 million square feet of vacant retail space throughout the United States from both freestanding and shopping centers. A third of that is vacant big box space. There's been two problems that have fed this. Certainly consolidation in the retail world has been the major factor, but we also, I think, going into the end of the last cycle, we really had overdeveloped retail space. You know, the latest statistics from ICSC show that the amount of retail space in the United States has grown at a rate of over twice of the rate of the population growth between 1970 and 2009. If you go back to 1970, there were 29 square feet of retail space per citizen in the United States. 2009, it's 46.6 square feet of retail space per citizen. So we're really facing challenges on two fronts, overbuilt inventory and then the consolidation that we faced. Looking at what's happened over the last few years, we've tracked 120 million square feet of big box space that's gone dark just since January 2008. Add that up, that's the entire shopping center inventories of Baltimore, Cincinnati, Kansas City combined. So it's a really huge block of space that's come back to the market. And again, retailers and consolidation mode has been really what's fueled that. This is just a sample of some of the players that have returned space to the market. As you see, Linens and Things in Circuit City together accounted for over 35 million square feet of space coming back to the market. And there's a few other recent ones that aren't on this list. For example, Sam's Club just this year has put back over 1.2 million square feet. Retailer bankruptcies have played into it, certainly with Linens Things, Circuit City, and not just the concepts that have gone out of business. For example, Bilo and Bosch's, two regional grocery chains, also recently have fed space back to the market. Bosch's in Arizona has closed 10 of their stores while going through bankruptcy proceedings. Bilo closed 17 stores, but they're canceling 31 leases. That's a lot of grocery store space. Both of those retailers tend to use about 50,000 square feet of footprints. So that's a lot of space coming back. So it shouldn't be any surprise that the impact has really been a great big 1-2 punch for landlords. What we've seen as far as leasing is that if you look at space that prior to the economic meltdown was leasing, say, in the $15 to $16 square foot annual triple net range, that space now is generally in about the $10 per square foot range. We've seen some space where retailers providing their own TIs have been able to land space as low as $5 a square foot. That's the exception to the rule, but pretty much across the board, we're seeing rents discounted 30 to 40% from where previous tenants have been paying. And you know, it's gone beyond that in terms of the leases that we're seeing done nowadays really have changed. It used to be 20-year deals were the norm. 10-year deals are the norm now, and certainly tenants are also demanding a lot more early exit options in their leases. As far as sales, certainly it's no surprise that sale pricing for all commercial real estate investment types have been off significantly. I think the latest data from Reese was showing pretty much 40% across the board is the number that we're looking at for most product type. That's the same thing with retail, although certainly that's where we're talking about stabilized big box properties, those that have strong national credit tenants in place, whose futures are not in doubt, who have long-term leases in place. So we're seeing a 40% discount in general just on those strongest properties. Certainly, there is some good news is that we've seen a little bit of a bounce recently, and if you have a stabilized big box property in a strong urban market, there has been some slight pricing increases as of late, but still the overall news for existing owners has been pretty bleak. The news, of course, has been worse for those owners who either have properties with weaker tenants in place or who have no tenants in place at all. Certainly we see a huge difference in cap rates depending on who your tenancy is. It used to be that people would call and ask me what's an average sale price, and now it's a qualified answer that I have to give. It really depends on who's in your building. And certainly we see a difference in cap rates just between occupied buildings depending on who the players are. Certainly there's a number of players out there like Borders, Rite Aid, for whom there's a lot of concern in the marketplace about their financial health. Properties with those tenants in place are displaying higher cap rates than those with, say, perhaps a Best Buy or a Bed Bath & Beyond. But it's nowhere as bad, of course, when you have just a flat-out empty property. For example, we know of a former Dillard's in Akron, Ohio that recently sold as part of a redevelopment play for $1 a square foot. So if you get into some of these smaller markets, rural markets, and you're dealing with big box vacancy and you're trying to sell that property, we have seen deals go for pennies on the dollar. One example of the difference it can make, recently there was a former Kmart in Highland, California that had sold in 2005 while occupied for a price of $64 a square foot. Kmart since has gone dark, and that property just sold a couple of months back at $17 a square foot. So the discounts on pricing are quite large. It's a huge challenge. If you look at the overall averages, nationwide we're seeing big box trade at $97 a square foot, but that's factoring in all property types. Again, occupied boxes we've seen routinely trading above the $150 a square foot mark, but vacant we've seen things generally below $75 a square foot. And the cap rates, again, if it's vacant, we're generally seeing 10% or above, although we have seen some 6 and 7s for some of the strongest occupied urban boxes. Now, I have a list here of some recent sale transactions that might be of interest to people on the call here. And one thing I wanted to mention is that I am going to be sharing this presentation with anyone who would like it. At the end of the presentation, there will be my email address, contact information. You can contact me. And certainly the webinar is going to be available on the NAIOP website. But here's just a list of some recent big box sale transactions throughout the United States, kind of give you a bit of a sampling of what's out there, what's trading, and what type of pricing we're seeing. Now, I did mention that there is some good news, and that good news is that we are seeing a huge bounce in big box activity. In fact, we've called pretty much the bottom for the leasing market for retail nationally as of the second quarter of this year. What we track with our 11% vacancy for shopping centers, we do see that just decreasing over the next year. There's a couple of reasons. Retailers are back in the marketplace. The retailers that we track over 2,500 of them and their space requirements. We basically have seen the amount of space requirements go up by about a third this year compared to last year. And one of the huge drivers of that are big box users. Certainly, there's a couple of reasons for that. Once-in-a-generation rents really is spurring a huge amount of demand. And, of course, the players that are active, they're mostly discounters. They're off-price apparel players. They're off-price grocery. And then there's a few ethnic grocery and organic grocery chains that are all in strong growth mode, that all are benefiting from the current economy and pretty much the new frugality that we're seeing from consumers. That being said, here's just a list of some of the people that are active in the marketplace. And to give you an idea, for example, 99 Cents Only, they're doing 15 stores this year, but they're looking at as many as 30 next year. A.J. Wright, 8 this year, 10 next year. Academy Sports, 10 stores this year, 20 next year. Aldi, discount grocery chain, small format, huge expansion push, 100 stores, give or take, this year, and probably the same level of development next year. Ashley Furniture is out there in the market. Could be as many as 50 stores by the end of this year that they'll be finishing with, and their goal is about 100 for next. Bed Bath & Beyond, they've got 30 in the pipeline for this year, but we could be looking at as many as 140 stores next year. Best Buy, 55 this year. They're going to jump that to about 170 stores next year. And the list goes on and on. Big Lots, 80 stores this year. Not a big surprise, discount grocery concept. Those guys are putting in solid same-store sales, and they're really picking up a lot of market share. Big Lots is looking at 100 stores next year. Burlington Coat Factory, which one thing we love to see is any users that are above that 50,000 plateau. Burlington usually uses about 80,000 square feet. They've got 30 stores in the chute for this year. Could be looking at 40 next year. Costco, even though they're just doing about 14 to 15 stores this year. They are looking at boosting that to as many as 23, 24 next year, and it could be pushing 30 stores by the following year. Dick's Sporting Goods, large sporting goods chain, 25 stores this year, 30 next year. Dollar Tree, 25 stores, another 25 with their deals concept. Famous Labels, another discount apparel group, 25 stores this year and next. Forever 21 could be looking at 80 stores, 80 additional stores over the next 24 months. Fresh and Easy, this is Tesco's concept. They use about 20,000 square feet. So far they've just been out in Southern California, Phoenix, and Nevada. They're going to have a huge push starting in March next year for Northern California, Northern Nevada. We hear Chicago is next. But we're looking at least 40 stores opening in the next year, not counting what they're going to do in Chicago, which we expect probably another 30 to 40 stores over the next couple of years. Goodwill stores. No surprise, Goodwill, Salvation Army, they're the ultimate off-price apparel players. They've been looking at 100 stores through the end of this year and possibly another 100 next year. H&M, not an off-price apparel player, but a European chain that is looking to expand here. There's a couple of them. Zara is another one, but there's a couple of new concepts coming to the market. H&M is going to be finishing this year with about 30 new stores. Hobby Lobby is expanding to the West Coast. They've got 30 stores in the chute this year. I hear that they may be exceeding that growth level for next year. And keep in mind, all of these players are dealing with 20,000 square foot footprints or greater. I should probably clarify, for the purposes of our report, there are some people who classify big box as just 50,000 and above. We really are including what you'd also consider junior box and junior anchor spots of 20,000 square feet or more. So you see all this activity coming down the pike. Even JCPenney, one of the few department stores that's active, has got a 5-year plan for 30 new stores. Joann's got 30 new stores in the chute for this year. Kohl's has already done about 30, and they've got about 30 in line for next. Marshall's, which along with TJ Maxx, the two TJX concepts, they will close the year with about 45 new stores, and they could be looking at 50 to 60 for next year. I can go on, and I probably have gone on too long. But you get the idea is that ultimately we are seeing a huge growth spurt from the off-price retail world. And the good news is that these retailers are actively swooping down on big box space. And one thing we haven't even seen hit yet, which is also going to further spur this growth, is what's going to happen with Walmart next year, which I think is going to be the biggest retail story of 2011. Walmart has thrown out the playbook. In the past, they mainly went with ground-up development with a template that was anywhere from 150 to 180,000 square feet for their superstores. They've thrown that out. Now they are looking for stores as small as 20,000 square feet. Excuse me. They're going to be expanding with at least 300 to 400 stores next year in the United States alone. Huge push in most markets. Give you an example, they're looking in New York, possibly as many as 20 stores, Queens and the Bronx. They're also not ruling out Manhattan. They're also looking at a similar number of stores in the San Francisco Bay Area. Sacramento, where I'm based out of, they're looking at least 12 locations, could be 20. Cleveland, 12 to 20 is what I'm hearing. Cincinnati, same numbers. Detroit, I'm hearing that they could be looking at as many as 25 stores. They're doing this for a number of reasons. First off, by going after second-generation retail space, they're getting the deals that are out there in the marketplace today. Secondly, they also can get penetration in some of these urban core markets where they've just not been able to get into before. Generally, they've run into issues with finding enough available land or with pricing. And certainly, Walmart is a bit of a controversial player. There's plenty of people who aren't big fans of them, and the labor unions are certainly at the top of that list. What we've seen is that Walmart's run into a lot of development issues in major markets, dealing with harassment lawsuits, environmental lawsuits, all these things that plague new development. this is a great way for them to sidestep it. And if you look at some of the markets they're going into, they're looking for the working class neighborhoods. They're looking for the sites that have faced the most challenges in this economy. So they're looking to grab market share quickly and in a big way. It's very difficult for the mid-range grocery players, the Super Values, the Krogers, the Safeways of the world, to compete with Walmart pricing, not just because of their buying power, but certainly Walmart's not unionized. So this is a grab for market share. It is going to have some consequences for the grocery world, which we'll be talking about in a second. But that's a huge amount of space that they're going to be taking down. And like I said, they threw out the game book on this. We're not just looking at 20,000 square foot stores. For example, in Southern California, they just recently bought a former Mervyn's department store in Torrance and one in the San Diego area as well. That's an 80,000 square foot template. They're going to put 80,000 square foot grocery stores in place there. They recently were in a bidding war up here in the Bay Area in Concord for 80,000 square foot Mervyn's. They ended up losing that to Safeway, who, by the way, is one of the smart moves for the mid-price guys, is going to be focusing on getting the best real estate, and that's going to be one of the strengths of the existing players in the markets where Walmart's seeking penetration. But believe me, there's going to be a full-blown grocery battle in the coming year. Still, that being said, the good news for landlords is space is starting to move. The best moving spaces really have been the Circuit City spaces and the former Linens and Things spaces. That 30 to 40,000 square foot template, that's where we're seeing the most users. And to give you an example, H.H. Gregg alone, Indianapolis-based electronics chain that very few people outside of that region had heard of just 2 or 3 years ago. They've been on a huge growth spurt. Single-handedly, they are going to take down about 2.5 million square feet of just Circuit City space through 2011. Just 2-3 days back, they announced 10 new stores for the Washington, D.C. market. So they're on an expansion tear. Best Buy is also hugely active, and they're chasing Linens and Things space as well as former Circuit City space. But they're not the only ones. TJ Maxx, Marshalls, Ross, a number of the retailers that we just discussed. Now, things are a little bit iffier when you start getting beyond that 50,000 square foot level. The good news, for example, out west, Mervyn's regional department store chain that went bankrupt in 2008, they vacated over 11 million square feet of space. The good news is that within the next few months, half of that will already have been backfilled. Kohl's and Forever 21 and Burlington Coat Factory have been among the most active players. Hobby Lobby as well. We know of a couple of former Mervyn's that were demised to accommodate Hobby Lobby with their 30 to 40,000 square foot template. One of the more interesting things that I'm seeing, though, is that throughout all of these trends, we're seeing retailers, just like Walmart is doing, is throwing their old footprints out. And it's really about getting into urban markets, getting deals. Forever 21 is probably the ultimate example, is that just 3 years ago, Forever 21 had a couple of different mall concepts, one that was about 4,000 square feet, one that was about 10,000 square feet, and I believe they also had one that was 15,000 square feet. Well, they now occupy a 200,000 square foot department store in California's Central Valley. They've got a number of former department store spaces, 100,000 square feet or plus. They have tweaked their format and essentially reinvented themselves to take advantage of real estate. More unusual, Costco, never a mall player. Well, they just signed deals for 3 mall sites with Westfield. They've got a site in Sarasota, Florida, one in the Baltimore, Washington, D.C. market, and I believe that the third one's in the Los Angeles market. They're going to be going in as an anchor tenant at a mall. So great news for any mall landlords who've been struggling with what do you do with 100 to 200,000 square foot department store space that's gone dark. And it certainly is going to be interesting to see, are we going to see more of this in the future? Are we going to see the tenant mix at malls starting to change? I think you can count on it. People are going to be watching this very closely. Target, meanwhile, Target is active in a couple of fronts. One thing that they are doing is that they are starting to look at coming up with a smaller footprint that I've heard could go as low as 50,000 square feet so they can penetrate urban markets like San Francisco. Typically right now they're just doing 120,000 square feet or more. So expect to see more targets being active. I understand they're in the process of trying to do a deal in that 50,000 square foot range for downtown Portland, Oregon. That might be one of their first test stores. Now, looking at all this activity, the good news is that we see about a total of 40 million square feet of vacant big box space being backfilled over the next few months. And that would basically be a third of the space that's been vacated since 2008 when the economy hit the skids. So that's huge news. The bad news, of course, is that still means we have 80,000 square feet vacant. But let me point out to you where the activity is happening, which properties are strongest. And essentially, you can break the market into just 3 tiers of product. And first tier big box product would pretty much be locations within busy shopping centers that had gone dark. Freestanding boxes in the prime urban or suburban corners, and certainly across the board the activity has been focused primarily at boxes under 50,000 square feet. The majority of the deals have been happening in this size range, although we do have a good amount of activity in that 50 to 100,000 square foot size range. But this is where the action is. This is where the lion's share of those deals are getting done. If you look at what we call our second tier locations, this would be weaker shopping centers, some older aging shopping centers that have boxes that went dark. Then there would be boxes that are really on weaker intersections but still within urban or suburban trade areas. And then just in general, boxes in that 50 to 100,000 square foot range. And certainly one of the problems is because the majority of the active space users are dealing with a 30 to 40,000 square foot template or less, demisement is going to be key for landlords looking at landing these tenants. It can be tricky because depending on your type of store, the expenses can be quite large. We know of a case where Hobby Lobby went into a former Mervyn's in Phoenix, and the demisement costs came out to something along the lines of $3 or $4 a square foot, which actually wasn't that bad. It gets a little bit trickier, for example, if you're trying to chop up a warehouse store. All sorts of HVAC issues, plumbing issues start coming into play. So it's a real challenge for some of those larger boxes. Now, in the second tier range, we're looking at it probably taking about 4 to 5 years to backfill the majority of this product. Most of it we do see as being backfilled. The real challenge we see going ahead would be in the third tier box locations. Certainly anything above 100,000 square feet, it's a huge challenge to land a space user. But it gets a little bit more complicated if you look at some of the weakest shopping centers, some with issues of aging, of basically markets passing them by, poorly situated freestanding boxes, and of course the real challenge is rural big box. Rural big box, we already had issues with vacancy going into this meltdown. One of the things that we did here at Colliers is we went ahead and we surveyed 100 rural big boxes that are currently on the market. And one of the things in doing that, first thing we determined who the previous tenant had been. And in 40% of the cases, that past tenant's prime competitor was active in the marketplace within a 1 mile radius. But kind of more shockingly, in 20% of the cases, that same tenant was still active in those rural marketplaces within 3 miles. And one of the things that we've seen in rural America that's just been a challenge has been boxes, retailers upsizing to new boxes, leaving their old buildings behind, and they're not being tenants for those boxes. That was an issue before we got into this economic mess. It's going to be an issue going forward. And in all honesty, we look at the best options for a lot of these properties is either creative adaptation to non-retail uses or just flat-out demolition. Now, that being said, we are seeing a lot of interesting creative adaptation out there, not as much as we're going to be seeing in the near future. But here's a prime example. The Spam Museum in Austin, Minnesota. This had been a Kmart. It's a 30,000 square foot building. It now basically houses about 16,000 square feet of Hormel Foods offices, and the remainder is the Spam Museum. It's one of the more successful and creative rural adaptations that I've seen. It actually was brought up in probably the ultimate book on the subject called Big Box Reuse by Julia Christensen of the MIT Press. Definitely worth a read for anyone who's facing this challenge. Now, this particular example here, I really wouldn't say is about adaptation to a non-retail use, but I do think it's probably the best outcome of an adaptation. Mervyn's store in Rockland, California, that was recently converted. In fact, it just opened up about 2 months ago as a Cineplex. This particular center had been hemorrhaging tenants ever since the closure of Mervyn's. And basically, since leasing up as a theater, almost all of its inline space has since been leased out to a mix of restaurants and retailers who wanted to be in a center that would have that traffic that a theater would bring. So in essence, we think that this particular shopping center, after going through this ordeal, has emerged stronger because we see that theater tenant probably being a better draw than what Mervyn's was. That being said, where are we seeing the most uses and where do we see the most opportunities? Medical use and clinics, particularly in rural areas, this is going to be a huge trend in the near future. We've been working with a company in Minnesota that's just pursuing rural boxes that are vacant. If it's in a shopping center location, they believe strongly they can turn that into medical use. And it makes some sense, you know, aging boomers, you've got medical demand going up, and then certainly the passage of the Affordable Health Care Act means 30 or 40 million more insured Americans sometime in the next couple of years. So we do see upside potential there. Office use, we're seeing a little bit of conversions, not a lot. Obviously, there's issues in the office market, and there's great deals to be had there. But we have seen a couple of projects that have gone for that. Certainly, educational use, libraries, vocational trade schools, community college, those are all huge uses, especially for shopping centers. They're attractive in that they bring bodies into the center. They might not command as much rent as the previous retailer, but it does get a captive audience there. And then we actually have also seen some rather unusual ones where Department of Motor Vehicles have actually gone into some shopping centers and some police stations as well. Probably the best example, this actually was done a few years ago, of an adaptation for educational use, shopping center in Pomona, California called Village Indian Hill that had been basically about 50% vacant for a number of years. They converted half their space to a community college. So now they have a captive audience on one side, and then they have retailers who benefit from the students on the other side. We're also seeing a lot of activity from health clubs and gyms, sports and entertainment uses. Certainly, one of the cheapest conversions you can do is the indoor go-kart racing. We're seeing a lot of that, a lot of indoor miniature golf, a lot of Dave & Buster's type concepts. For example, this is a 45,000 square foot Toys R Us in Jacksonville that my company recently leased to a tenant called Latitude 30, and they're going to basically do a Dave & Buster's entertainment center there. Have an indoor bowling alley, huge arcade, a number of restaurants and bars. That's becoming a much more popular use. This, deep in the heart of Texas, we see another example of creative use, reuse. This is a Circuit City that in League City, Texas, has been converted to a gun store and an indoor shooting range. We've actually seen a couple of those pop up. We've actually seen a number of creative temporary uses. For example, CompUSA sites seem to be popular in this, and there's one in my hometown here in Sacramento that's been used as temporary museum space for the last couple of years. And then Honolulu's CompUSA recently was used for a new George Clooney movie, and I believe that it's being used now as a set for the new Hawaii 5-0 TV show as well. But we also see a lot of churches, consignment concepts, swap meets, and worst case, we do see people looking at warehouse distribution space, even self-storage, as being alternatives. Here's that George Clooney CompUSA I had mentioned. So we're finding a lot of ideas out there, a lot of really good ideas. In fact, here's a list of some of the more recent conversions that we've seen out there in the marketplace, what they were and what they've become. The one downside we're seeing is that there's no shortage of ideas. It's about capital. That's what's in short supply. Now, that being said, it's no surprise a lot of landlords are strapped, and these are costly conversions. We do think that this is going to explode as a trend in the coming years, and essentially, it's going to be fed by distressed assets that are trading in hands. As we get new crops of owners with deeper pockets who are going to find some great deals out there, you're going to see a little bit more capital available to make these conversions, and it will positively impact vacancy levels in the long term in the distant future. So, looking ahead, is the outlook for big box bleak? No. Will we be able to backfill all of the vacant big box space in the marketplace today? No. We will be able to backfill a good chunk of it. And with conversions to non-retail use, I think that we can backfill the overwhelming majority of it and keep demolitions and teardowns to a minimum. But that being said, and even with repositioning of boxes, we're still probably looking at least 7 years or more to work through the 120 million square feet of big box space that's been vacated just since 2008. So that wraps up my presentation. Again, I'd be happy to share this with anyone on the call. Feel free to email me at garrick.brown@colliers.com, and we will be having the webcast put up on the NAIOP website as well for anyone who'd like to check it out again or download it. Thank you.
Garrick, thanks for a great presentation today. That's, they always say the good, the bad, and the ugly. That was the good, the bad, the ugly, the weird, the celebrity. I mean, there was all kinds of things there. Lots of ideas for what to do about this big box dilemma. And, I think there are some challenges, and there are definitely some opportunities. So gave us a very, very thorough overview of that segment of the market. As Garrick said, if anybody wants to hear the presentation again, they will be available by close of business today on the NAIOP website. To get there, you just go to naiop.org, and there's a large button on the front page that says Solutions Series, and that's where all of the past programs are archived. So you might want to look around and see some other topics that interest you. We have our next Solution Series program is going to be on October 13th. We have George Livingston. He's going to be explaining something called the EB5 program. This is a bit complicated, but it's definitely an interesting idea for attracting foreign investment and how it works. So watch your email for a message from NAIOP Corporate. We'll give you more information about that Solution Series program. And just a final reminder, if you have some topics you'd like us to cover or somebody you think would be a good presenter, please go ahead and fill that out at the with that little survey that you'll get at the close of the presentation. Thanks again to you, Garrick, for a terrific presentation, and thanks to you all for your attention today. We hope to see you at the next Solution Series program.